In this video, you'll be learning about this topic. So, Michael, I want to transition into a conversation about this big decision that you made, and then we'll talk about the second big decision that you made. And before we talk about it, I want to frame this up, and I want to see if you agree with the way I'm framing this. So you started your company, and your company has been profitable for decades, and you guys had $475 million of retained earnings. Those are the profits that you guys as a company collectively made, and you had that in liquid cash. You go out after 30 years of creating this treasure chest of cash. You go out, you buy Bitcoin, $475 million worth of Bitcoin. And for all intents and purposes, it's doubled in value within 6 weeks. 6 to 8 weeks or whatever it was. And so you've effectively walked through a time warp of value creation in, I don't know what percent that would be, but I would think it's less than 1% of the time that it took you to create it, and you doubled it. Is that how you see what has taken place since October or September or whatever it was when you first put on this position?
Yeah. Yeah, I see that. Look, I think that we went through a transition in March where the cost of capital went from 5% to 15%. And a rational person has to say, looking forward, the cost of capital is 15%, and the currencies are being devalued at 15% a year. In the Western world, they're being devalued at a faster rate in the other parts of the world. That means cash is a liability, not an asset. And it means that every fiat instrument based on cash, stocks, bonds, and real estate are starting to look like they need to be discounted at 15% a year plus the risk premium. So, unless it's a monopoly, and there's really no such thing other than, US sovereign debt, everything else has some amount of risk on it. And so you're talking about cost of capital that's looking like 18 to 20%. So we got to this point and we looked at it and we just said, well, we're going to have to do something to remain solvent. Right. And if you're
from a perspective of keeping pace with your buying power, when you say the word solvent,
I guess you would say if you want to preserve shareholder value, you're going to have to do something different than hold cash on your balance sheet. The cash becomes a minus 15% liability per year, reasonably speaking. So let's talk about corporate treasury strategy. So we're in an environment now where it's reasonable to think that the hurdle rate is 15%. And the currency is going to devalue by 15% a year for the next 4 to 5 years. That's the best guess. It could get worse. It might be a little bit better. But once you crank that assumption in, then you have to say, is cash an asset or liability? Well, cash is a liability. If you want to preserve shareholder value, which is the same as preserving wealth, which is the same as preserving value, right? If you wish to store value, then at 15%, you're going to lose 75% of the value in 10 years. You're not going to be able to buy anything with it, any asset with it. You can't really focus on inflation rate. You got to focus upon the cost of capital. Now, if you look at stocks, bonds, and real estate, the issue is they've all got a yield on them, but the yield probably doesn't beat the risk premium, or probably isn't. I mean, the yield of the dividend, et cetera, yeah, you're getting 3% or 4% or whatever. But at the end of the day, the credit risk of holding a bond that yields 5%, is such that you're stripped down to 2% risk-free or so. And so you're still going to be looking at something which is 10 to 15% dilutive every year. So stocks, bonds, real estate, they're not going to hold value either. People, I think they delude themselves into this thinking that they're safe in these things, but I think we're at the end of the road for stocks, bonds, and real estate because they've all been inflated to a max by the progression of the interest rate to zero and by the leveraging up of all the companies to put as much cheap debt as they could in order to get the most amount of leverage. And at this point, there's not any more leverage you can put on these things, and you can't put the interest rates below zero effectively. So a reasonable estimate is if you park $500 million in any of that stuff, you're still going to lose 10% to 15% a year. You're going to think maybe, these traders, they think, oh, I can take leverage and trade this and that, and I'm a stock picker, but at the end of the day, you're going to make as many mistakes as you make good guesses, and you're not going to outdo the money or the return on the money, which is going to be minus 15%. So you're probably staring at the same minus 15%, and you might actually get horrifically worse than that. I mean, right? There's worse results than losing 15% a year, right? If you invest in companies, they go insolvent. But the best result is you're just holding a market basket of assets that the Fed is going to buy, and as the Fed buys them, you've got that inflation. So, what are you going to do? Well, I've got this thought in my head, Preston. I don't know why I have it, but it's been just in my mind. I'm almost dreaming this thing now. It's the road to serfdom consists of working exponentially harder in order to earn a currency growing exponentially weaker. Like if you're an individual, you're that dude in New York and you're working to make 500 grand a year, and then you want to raise, and you keep taking risk and you work harder and you stay longer and you keep struggling. But the house in the Hamptons is going up faster than you can work harder, right? It's the road to serfdom. If you play that game, you have a company that makes 50 million a year. You're going to make 50 million a year, and you're going to try to grow the company faster than the hurdle rate. I have to grow the company 20% a year to stay ahead of the 15% hurdle rate with the risk premium. How are you going to do that? You're going to take risk. You're going to throw money at the problem. You're going to throw people at the problem. You're going to do an acquisition. You're going to do a dilutive acquisition. You're going to take a risky trade. This is and you're going to try as hard as you can in order to make money, but no matter how hard you work, you can't grow faster than the rate at which the bank can print money. So I'll give you another metaphor. You have one of those heart rate monitors and you march up a mountain. When you get to 9,000 feet, you ever check your heart rate? My heart rate's beating 20% faster. I'm like, why is my heart beating 20% faster? Well, if you do the quick altitude check, and you know this, you're a pilot, there's 30% less oxygen in the air at 9,000 feet or some number like that. So if I take 20, 30% of the oxygen out of the air, my heart's got to pump 25% faster to move the same amount of oxygen in order to keep me alive. Now, if I just keep marching you up the mountain, 10,000 feet, 12,000 feet, 15,000 feet, your heart has to beat faster and faster because the oxygen's falling out of the atmosphere, and eventually your heart bursts, right? But happens all the time, 55-year-old dude goes on a ski vacation with his buddies from college, and they get up and he skis down the slope and he drops dead of a heart attack. I don't know how that happened. Well, I know how it happened. It happened because your heart's beating 25% faster and you're under stress and you're not as in good shape as you were when you were 25, and so what we're doing is, as we crank up the hurdle rate, individuals, you either have to work harder, 25% harder, or you have to take more risk in your portfolio, and you keep doing all these risky trades.
So what you're really saying is everybody's hypoxic right now.
Yeah. What I'm saying is that What I'm saying is that a government official took you into a room, put you onto a hamster wheel, and then they told you to run as fast as you can. And they told you that if you run fast enough, they'll keep pumping oxygen in the room. And then they started pumping 20% less oxygen in the room. And then you ever try to run on a treadmill at 9,000 feet, Preston?
That's nuts.
I've done it. I mean, in athletes, you do. By the way, why do they train Olympic athletes like at altitude? It's like twice as hard. So you're on a hamster wheel or a treadmill. The oxygen is getting sucked out of the room. You're trying harder. Your heart is getting revved. And at some point, you have a heart attack. And your heart burst. And what is an example of this? It's like every company that was a low growth company in the last decade, and they're trying to stay ahead of the hurdle rate. So they take on debt and they leverage up. And then there are two ways that companies try to stay ahead of the hurdle rate to keep shareholder value. One way is I do acquisitions. I'm buying a company. It's a dilutive acquisition. It's taking massive risk because it's really hard to integrate two companies together. There's a 90% failure rate. But I see companies do this. They're doing acquisitions and then they fail. The number one reason that all software companies fail in my entire career for 30 years, I watched this. Number one reason, bad acquisition.
Yeah.
Now, the other thing they do is they borrow money to buy their stock back and they leverage up. So I'm going to borrow Oracle, borrows tons of money, buys their stock back. Now we're holding 40, 50 billion in debt on the balance sheet. Toys R Us, we're borrowing money, buy the stock back, we're leveraging up. That's another way to get ahead. And you want to put these two together in the most, toxic cocktail. I borrow money to buy another company. And so I put them both together. I'm either leveraging risk or I'm leveraging to take my shares out of production. And this is the road to ruin. It's the road to serfdom. And it all starts with somebody on the board of directors or an outside investor saying, you're going to have to generate more than 8% growth. I need 8% share growth. Amazon's, growing 20%. Why can't you grow 20%? Okay, so here's the last gotcha. Like, not only do you have to work harder, you're not growing 10% a year, you're a loser. Not only do you have to take on more risk, you can't grow 10%. Why don't you're running a bakery. Why don't you launch a bar down the street? Why don't you expand into a foreign town? Why don't you buy your competitor? Why don't you do a leverage trade on options? Why don't you do something different? So I have to work harder. I have to do risky stuff. And then the third part is, and by the way, you have to compete against big tech monopolies that have infinite free money and infinite power, that have the ability to ship products to 100 million people over the weekend for a nickel. You got to compete against Microsoft. They have every company on earth is their customer now. Okay. So what's that feel like? Well, they can just ship anything they want to every customer on earth. Now, you think that's not an advantage? You got to compete against Amazon. You got to compete against Apple. You got to compete against Google. You got to compete against Facebook. So as the bankers are basically they're giving free money to the big corporations, they're also putting you on this treadmill where you have to go faster and faster and do riskier and riskier things. And those three dynamics, right, are a road to ruin. And that's why so many mid-sized businesses and small businesses are getting crushed by this economic environment we're in.
Do you see Square and PayPal really disrupting traditional Wall Street banks moving forward, based on what your understanding of Bitcoin, the fact that they are way out in front of many others in their adoption and integration of that. How do you see that playing out as far as the finance sector?
Let's talk about that. I talk about the problem. The problem for corporations, right, is they're being squeezed toward insolvency by competition and cost of capital, and the requirement to like beat this hurdle rate. The solution is Bitcoin. And how, the solution is I have to either plug my P&L into a monetary network, an accretive monetary network, or I have to plug my balance sheet into a monetary network. So Bitcoin is the world's first engineered monetary network, and it is an accretive asset. It's like an asset growing more than 100% a year versus the dollar, and that's one way financially it makes sense. But it's also a big tech network growing faster than 100%. So if I'm Square or PayPal, they're competing against Google and Apple, right? So you could say, oh, they're big. Well, actually, they're competing on one hand against JP Morgan and Citigroup and Wells Fargo, against monster banks. But on the other hand, they're competing against monster big tech companies, Amazon, Apple, Google, Facebook. Okay, so they're really the upstart challengers, and they're in between these two worlds, the old world of banking and the new world of big tech. So what's your best idea there? Well, the best idea is plug your mobile payment app into Bitcoin, because Bitcoin needs a high-speed payment rail. Bitcoin needs a stable currency solution to buy coffee. Right. So Square and PayPal solve the problem of how do I buy coffee with Bitcoin? And they solve the problem, and they give you a rapid payment rail to every Visa, compliant merchant on the planet. But what they get for themselves is, this is not really about Bitcoin. This is about Square. Square needs to do this because Square is able to offer all of its customers a savings account that yields 100% interest yield, tax-free.
On an annual basis.
Yeah. If I put my $1 million or 100,000 or 10,000, whatever the number is, if I put 100,000 into Bank of America or a conventional bank, I'm going to get 25 basis points. It's a liability. And in 5 years, it'll purchase half of what it would purchase today. So I'm going to lose half my wealth while I get no yield. That's one option. The other option is I put my $1 million into Bitcoin off of the Square Cash app. I think they're like, whatever, it takes 20,000 a week or 10,000 a week. So maybe let's call it $100,000. I put $100,000 in the Square Cash app, and it doubles next year, and it doubles, and it doubles, and it doubles. And pretty soon you have $5 million. And that's how you buy that house. Maybe not in the Hamptons, but maybe, down the street from the Hamptons, starting from 100,000. And the thing that makes it compelling is A, it's accreting at north of 100%. B, A, it's accreting at all. B, it's accreting north of 100%. It's hyper growth. And C, it's accreting tax-free, right? Because you want to give me a bond that gives me 10% interest taxable? Well, 10% taxable is 6%, 5% in California after tax, right? I'm taking all the risk. This is why, all the yield farming and chasing after yield and everything doesn't necessarily make sense. You're taking huge risk to get 12% interest, and you're going to pay 6% or 4% tax, and you got 6% after tax. You'd be better off to hodl. Just take your Bitcoin or take your whatever, put it on the network, leave it there. The network's growing. It's up 200% this year, right? But we don't have to be super optimistic. Let's say I just estimated it's been growing more than 100% for a decade, but I'm going to estimate it's going to grow 20% for the next decade. Because 20% is 1/10 of what it did this year, and it's 1/5 of what is done any year for the most part. And so once I make that decision, I got a savings account yielding 20% tax-free. That's the same as yielding 35% return consistently taxable. Okay, what bank on earth gives you that? No bank. But which company, which piece of real estate, which bond, and which stock will give you 35% dividend? Nobody. So now I go back and I say, do I want to keep my money on Apple Pay or Google Pay, or do I want to put it on Square? Well, the answer is on Apple Pay, it gives me 0 interest. I'm going to lose half my wealth in 3 years. On Square, I'm going to get a 20% interest, 35%, pre-tax, tax equivalent interest. And so it's very simple. Money is going to go, capital is going to flow to wherever you get the highest tax adjusted interest rate. And the beauty of Bitcoin is because I just buy the Bitcoin and hold it, it's a 0 coupon bond that's appreciating. It means you don't have all of the anxiety of managing city tax. New York City taxes you. State tax, New York State taxes you. Federal tax, federal government taxes you. Every other country taxes you. Property tax. You don't have the anxiety of income tax, all sorts of other types of Medicare, Medicaid taxes. Every other thing, dividend tax rates. These are all massive questions, and Warren Buffett and any great investor would tell you that 40% of the challenge of investing is just the tax efficiency of the investment. If you're perfectly right, you lose 40% of whatever just from being wrong on tax or more potentially. So for Square, this is a game changer. Now, once Square did it, PayPal's got to do it. It's the same thing. My competitor gives 100% tax-free savings account. Okay. The beauty of this is that Square and PayPal do this. They bring utility to the Bitcoin network. When Roger Ver barks, though, Bitcoin's only got 7 transactions a second or 3 or 4 transactions a second. You can't buy coffee with it, right? The point is 7 transactions a second is fine because what it's going to be, it is going to be Square Cash moving $182 million worth of Bitcoin once per day. And then they're going to do that settlement, and they're going to provide 37 million people with a Square Cash account, and they're going to do 187 million transactions a day on their network, right? They're like a second level solution. They're going to do 180 million transactions a day for 37 million people and settle it with 1 transaction against the blockchain. And it's going to scale just fine. Bitcoin wins, Square wins, the customers win. Everybody converts their Bitcoin into USD currency at the point of transaction.
Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on the next podcast episode and new investing resources.
What are your takeaways and thoughts on this discussion? Let us know in the comments section below.